Welcome back. And just a quick reminder, we will have a replay of today's session today at 6 p.m. Eastern Time, which will include the curriculum as well as the question and answer session. Use the same login credentials as you have for each session. Each day, it's the same throughout. This section is starting on page right where we left off, 363 with Mark. This will go for about an hour, maybe just a little bit less than an hour. And then we'll have another break before we queue up the Q&A. We have a bunch of questions already. Same situation, try to organize them all in a single email. I'm getting multiple emails from people. That makes it very difficult, as well as be specific with the page number and any specific details you want to ask. General or hypothetical questions are really difficult for Mark to answer. And remember, we will have another question and answer session on the live trading day on Monday, November 21st. So that is something where you will have more opportunity and chances to ask questions that we don't get through to today. Also, just a reminder, we will get into risk management tomorrow. So there's some questions I saw on information or part of the curriculum we haven't even yet gone over. So do try to be patient, as you will learn more, including right now with selling and risk management tomorrow. So stand by for that, and let's get back to Mark and Mark, page 363.
Okay, welcome back. We're going to look at sell signals now, sell rules. And to do this, the first thing we want to discuss, and we want to go back to a satellite view even. We're going to go back to the stage analysis. And the first thing we want to identify is sort of where we are in the bigger time frame. Where are we within that stage 2, stage 3, stage 4 a maturation, part of the maturation cycle? And we're actually going to look at the PE ratio here as something that could help us identify if that move that has been made in the stock is getting long in the tooth, if you will. This is one of the few times that I do use the PE ratio where it becomes valuable. But even with this, it's only on certain instances where you even get this type of tip off. But the first thing that is very basic, and that I always do every time I look at a potential buy setup, these VCPs, of course, we're making sure it's in a stage 2 uptrend, but within that stage 2 uptrend, since the stage 2 uptrend started, I'd like to know what base we're at, how many VCPs set up. And the reason why is because we're trying to ascertain how obvious it is and how, if it might be late, in the cycle. So if we're on the 5th or 6th time that you've had a good sized base form and the stock has made a really big move, and let's just say, you've been in a bull market for a couple of years, that is what we would refer to as a late stage base. And we've got to be a bit more careful with that. That's not what I would call investment grade. That would be more of a trading opportunity, because the most of the juice is potentially out of the lemon, if you will. And it's no secret, once a stock has made a big move and there's been base after base after base, and all these breakouts have worked, it starts to get pretty obvious. And there's an indication there that's giving you an indication that you may be late in the maturation cycle. So that's first. We want to know where we are. And basically the rule of thumb is when you're in the first, second, third base, those are more investment grade, if you will, where you can try to hold longer. And when you start getting a 4th, 5th stage basis, and certainly if you get 5th, 6th, you're getting to where you got to start moving to a more trading type style, and sort of take the money when you have it and get the money, get out when the getting's good. This perfect example is 2021, where we got into a late stage environment. I was tweeting it all year long on how percentage of stocks above the 200-day were diverging, and there was less and less participation. And we had already made a big move in the market. And so I switched over to just taking short-term profits, and it worked out quite well. And then, sure enough, we went into a bear market shortly after, within the next 6 months to a year. So those are the signs, and they could also be when you get a lot of late stage. My good friend Stan Weinstein, who is the one of the very first people to ever write about this, him and Wyckoff with stage analysis. He keeps track of what percentage of stocks are in a stage 1, 2, 3, 4, similar to how I keep track of the percentage of stocks above the 200-day. Very similar analysis. But when there's a lot of stocks, he calls them the good guys. When the good guys are in control, the stage 2, that's where the market's healthy. When you get to stage 3 or the stage 4, stage 4 is usually indicative of or signs that you're in a bear market when there's a lot of stage 4 stocks. Right now, you don't. Go ahead.
Just to point out, Mark, I just wanted to point out, if you just look at the character of this example in Amgen, how when you're doing the base count, each base is getting wider as it's going up the mountain, to the slide. Where are we on the mountain? As you go up, each one is getting subsequently wider. And that's one of your main tip-offs to say, not only are you on base 5 here, this is the widest base since the beginning of the move. It's telling you the stock, everybody's in. To Mark's point before, when there's thousands of funds that own these names, that's thousands of potential sellers, to create the other side of the mountain, if you will. And that's precisely the cycle we're in right now with, say, the old FANG names. All the funds own them, and they're now net sellers.
Right. And when you take a look, a couple of things. One, when you take a look at the stages, and you go back and you look at a stock that has gone through the 1, the 2, the 3, the 4, the 4 stages, and that whole life cycle, you'll find that during that stage 2, you'll generally have, before you get a decent sized correction or a top that's a secular top, you'll have anywhere between 3, 4, 5, sometimes 6 bases, and then you'll get that volatility. And again, with this Amgen, this is an arithmetic chart. If we go over to taking a look at Yelp, this is a logarithmic chart. When you get into really big moves and you're looking at longer term timeframes, you want to use a log chart, because the log chart will then adjust things percentage wise. What's 10% down here will be adjusted, will be the same here, even though the price is a higher price, right? A $20 stock just has to move $2 for 10%. $100 stock has to move, obviously 10 points. So you can see, as Mark just said, look how wide this later stage base is. Just like we looked at, I think it was Decker's, exact same situation where you came out of this primary base. Here's your first base forming, second, third, and then that later stage base here, that fourth, is very wide. It comes off about 50%, and this is a faulty setup. This is a faulty VCP, and sure enough, it tries to break out, but then it fails. It rolls over, because that's the indication that the supply is now coming to market. See, there's a lot of volatility now, and
you see too, Mark. Yeah, see, Mark, at how the volume is really piling up in terms of this fourth stage base as well, which tells you there are definitely institutional sellers. And then as the name breaks again, you see more volume coming. This is just, this is precisely what we're seeing in some of these names. You and I were saying earlier in this year, people calling Netflix and Facebook and, oh, they're great buys, they're off 30, 40, 50%. And you and I are saying, no, this is horrible. Institutions are going to be selling these names. And sure enough, all of those late stage bases have cracked and made new lows.
Yeah, this is just showing the characteristics for stage 3, what to look for, because that's when you're in that stage 2, and you start getting into these later stage bases. Sometimes a stock will pop up, and it'll have this big VCP, and you'll get excited about it, but you got to put it into perspective and make sure that it's not this late stage base that's already been 6 bases, and now it's got this big correction. The big correction, some people think like that's an opportunity. Wow, it had this big pullback, and they like it because it's down big. No, that's just the opposite. You want the stocks that are holding up the best, not the stocks that are performing the worst. Once they start getting real volatile, that's getting where a lot of supply is coming into the stock. Now, the PE ratio, and again, this doesn't always happen, but you can certainly take a look at it to get some additional confirmation if you're late stage or not. And when the PE, one of the things of looking at the PE is to look for PE expansion. And that's what we want. We actually want PE expansion, because when you have a stock that's moving up, if the earnings are coming out very strong, as we showed in valuation in the Apollo example, you went up 200%. And then a year or two later, after a 200% move, the PE was the same, because the earnings were moving just as fast as the stock price. The stock price was just adjusting for the earnings, and you were basically at the same valuation, even though the stock went up 200%. Well, when you get a stock that starts moving real strong and there's great earnings and there's some great story and the company's making a lot of money, what happens is that when it gets to the later stages, it starts to go faster than the earnings, and the PE starts to expand. And of course, you want that. You want a price that, takes off and goes up as fast as possible. But that's where you want to start considering selling, because now the price is getting ahead of the earnings. And when you start getting to where you move up a couple, 2-3 times where you've expanded, and now you're at 20 times. The PE was at 20 here when it first moving out of that. We're back to that Decker's example, as a matter of fact. You're coming out of first base. I was buying right here. Now you have second base, a third base, a fourth base. Now, when you come up here and you start coming out of that fourth base, you're now 2 times, instead of 20 times earnings, you're at 40 times. You've expanded. You've doubled the PE now. When you get to 2 or 3 times earnings and you're on late stage basis, you are absolutely late in the game, and that's where you really got to be careful not to, especially kind of cut your losses, and you don't want to be holding and buying these stocks when they turn down, as we saw in valuation. That's where all the problems happen, right? So again, take a look at lumber liquidators, another one we looked at before. When I'm buying it over here, right, this PE starts to expand. But when you go back and you take a look later on at that later stage base, this is where we showed the high, low volume out, high volume in example. This was that faulty base because it was late stage. You had the PE had gone, when you started the stage 2 uptrend, it went from 20 times earnings to 50. So now that means that the price is moving faster than the earnings. It's getting ahead of the earnings, and that means the price is going to come down at some point. And sometimes these really expand quite a bit. Like this is more than 3 times. This was Chipotle, where here's your first base, second, third, fourth. When you finally got to where it started forming this last base here, which did not hold, you were at 65 times earnings from 20 times. So this is just some big, broad perspective stuff where you're looking at the big picture. And this is also for longer term investors. If you're short-term trading, certainly all your trades are going to be trading opportunities, and maybe even these late stage bases you could trade, because you're going to have tighter stops. You're going to be trading at the strength, and this might not apply as much. But this was very simple analysis that I did with Home Depot back in the 90s, where the stock, a couple times I was in Home Depot coming off the 1990 bear market going to 91, and the PE had expanded dramatically, and I had sold it off of a late stage base, and then it went sideways for a number of years. It was 5 or 6 years, and then broke out there. The PE came back down, and then again, this big move, you see the PE expanded again, almost to right around the same level of up around 70, 75 times earnings. And then it topped right there. And these were both off of late stage bases. You had a base here, you had a base here, you had a base here. When you got to the 4th or 5th base and they had the PE expansion, that's where you're getting late in the game. Now, the other thing too is that when you get to that later stage, it doesn't mean, again, that you can't trade the stock. Later stage bases sometimes get what we call a climax or a blow off run in that late phase, where the stock gets really popular and just it has the biggest part of its move. This is the acceleration phase. The key is to identify whether you're early and it's a breakaway acceleration or it's an exhaustion. And again, when you count the bases, you take a look if there's been a lot of PE expansion, you've been up for a number of, maybe couple years in the stock, a bull market's been underway, and now you get that acceleration after a bunch of bases. That's where you're going to sell right into that. We're going to show you that in just a second, some of the sell signals. Now, these stocks can also reset, just like we saw the failure resets with the pivot failure and the base failure. Well, on even a larger scale, you can reset. But what happens generally when you have a stage 2 that exhausts itself and then finally tops, and you get even a cyclical top can last years, and a secular can go decades. It usually takes a number of years, 3, 4, 5 years or more before you reset. And in this case, we reset over here. You got another new base. You're in a new stage 2 uptrend. See, it just starts all over again. Let me show you this example. This was Southwest Airlines. See, when you come out of this when you first turn into the stage 2, this first move here, it accelerates, but it's a breakaway move. You're in the early stage bases. Now you go 1, 2, 3, 4, 5. Off of the 5th stage base, now you're in an exhaustion. Now it's come a long way. It's come off a number of bases, and now you're looking for the sell signals. Same thing happened with Taser. Perfect example. I was in this later, and in part of that move where it started getting climactic. So when you first start, that's your breakaway phase. Then you get into the advancing, accelerating phase, and then the climax phase. That doesn't always happen, but when it does, and you're in the stock, it's nice. When your stock does that, you sell right into it. Qualcomm did the same thing. So many of these will start off like WR Grace. When I bought this, I was up in just 2 days. I was up 30% on it. So it was just starting to turn into a stage 2 uptrend. So I decided, what, I'm not going to sell this right here because it's just acting so strong, and it's in this early base. This could be just the start of before 3, 4 bases in this stage 2 uptrend. And this was a stock that was a company that was under heavy litigation for asbestos. They had a lawsuit, and that was resolving itself. And once that lawsuit got to a point where it was looking like it was going to resolve itself, the stock set up and was able to take off. So there was a fundamental reason behind the strength in this stock. So again, Tesla. So here's a perfect example in Tesla. You got that breakaway move. You got the bear market, the COVID bear market, set up that first big, deep cup with handle, if you will, had a number of bases, one here. And then you start getting into that later stage, right? And now we're getting more stage 3-ish, where the volatility is coming in and the moving average is starting to roll over. And now it looks like we're entering stage 4. Now this could be can turn back up here and maybe get back into stage 2, and we don't know when. But why would we try to buy it now in stage 4? I mean, I understand to buy it low, right? But we don't want the lowest price. We want the right price, right? So we want to be in stage 2. Remember, whenever you see your favorite name and it's down, go take a look. What stage is it in? All right. And remember, try to think back. 98% of the big winning names are in stage 2 uptrends before they make the big move. Do you want to be in, when you look at something like this and you're all compelled to buy it because it's Facebook, Amazon, Tesla, Netflix, Microsoft, NVIDIA, ask yourself, do you want to be in the 2% club or you want to be in the 98% club? All right, just be in this bottom fishing mentality. If you want to make efficient use of your capital and be in the stocks that move up and have big moves and make fast moves, you got to get away from this bottom fishing mentality and this cheap and buying quality. There is no quality. There is no quality in the stock market. If it doesn't matter, all stocks are risky. All stocks are bad unless they're going up. So that's the fundamental basis. That's the fundamental a starting point for being a super trader. So we're going to go over some specific sell rules now. I don't know if you have anything to add on that.
Well, I was just going to add too, Mark. I think this is really this list and sort of going forward, but to your last point as well about not getting lured in by buying quality. But for folks who are going to try and play these names for a bigger move, this section's really important because this is what's going to give you maybe you've been in a name like a Tesla, for say 12 months in the last cycle, but you want to look for, some of these signs to consider. If you're shorter term in nature, you're going to be trading multiple moves as a stock makes base after base. But for those of you who are looking to play these names for bigger moves, it's really this section I think you want to key in on to say it's time to, you know, part ways with the name, because there are plenty of generally warnings ahead of time to tell you, and that's what we're going to go over next.
Yeah, and money always finds a home. You know, while your stocks that are going in stage 4, that money is coming out and going somewhere else. Your job is to find where that money's going and to see where the stage 2 uptrends, where the new VCP is setting up, and the new names and the new technologies that are now the new leaders. All right, that's the key. Remember, money always has to find a home, so it's going to go somewhere. Anyway, let me show you something that Mark said about playing stocks for bigger moves. I'm going to show you how you're going to look for these same sell signals are going to be whether you're selling for a shorter term move or a big move. All right, they're both. And as a matter of fact, what's good in the short term sometimes is not good in the longer term. The same exact. That's what makes these rules kind of easy to follow. So remember we talked about confirmations. We had a bunch of days up, like there was, let's just say there was 9 out of 10 days up from a breakout. That's positive, right? That's a confirmation. Well, once the stock is extended, that's actually a negative, right? That's what you want to sell into, that strength. So that's why it's important to decipher where you are. I say, where are we on this mountain? Are we on the first base camp, or are we on the 5th and we're near the summit? So when you have 70% up days over down days or greater, especially when you have 2 tranches of that, and I'm going to show you exactly what that looks like here. So stock starts making a pretty good move. Maybe you bought the stock earlier, maybe you bought it over here, you've gone through a few pullbacks, and now it starts to accelerate, right? And here, 8 out of 11 days up. All right, so you'd say, well, that's a confirmation, that's good news. Yes, but now that you've gotten into a later stage move and you're at a good sized profit, that's where I start to sell. I start to sell into that is now a negative. What was a positive breaking out of a base, once the stock gets extended and starts to accelerate its rate of advance, it becomes a negative. And what I found is when you get 2 of those sort of back to back, and with that, you can look for, you'll get sometimes the largest up day since the beginning of the move. You'll get the widest spread. What you want to do is you want to start either selling into that strength, or at the very least, backstopping and watching for specific signs that institutions are jumping ship. And what the next thing you would look for is for heavy volume, a reversal on the heaviest volume since the beginning of the move. So now, you're up and away, and now you get that big reversal right here. You can see that reversal, and you engulf the previous day, and that's the largest volume through this entire move. Now, that's usually a sign where, if I were fortunate to be in a stock like this and hold this for this long, I would certainly start to reduce my position there, or as it starts to come down from there, I backstop it, and I would definitely be reducing. Then the real negative, and this just happened in a bunch of names. You can go back and look at Facebook and most of these stocks that just got annihilated in this last bear market, that were the secular leaders that topped. Almost all of them had big breaks on the heaviest volume. That's an absolute sell signal. When you have the largest down day on the largest volume since the beginning of the move, that is an outright run for the hills, because that's a sign, like we talked about before, that institutions are piling out. They're unwinding those profits now. So, and sometimes these all culminate together around the same time, but in chronological order, this is what you're going to see. First, you'll start running up, you'll accelerate, you'll get a number of days that are up versus down days. You'll have 70% or more of those days. You'll start to see the largest up day, wide spreads, and then after you get all that jubilation, then the selling will start coming in, because institutions liquidate into strength and they sell into the retail hands. Let me show you some more examples. This is where this does get a bit more complicated. It definitely gets more subjective. Mark, have you found that the selling side, because almost everybody that I ever talk to when I train traders, is the selling side and nailing down the profits and managing the trades that are profitable tend to be more frustrating or more difficult for people than handling the losses sometimes, where you set your stop and you're out at a level. There's a lot more a skill that you need to develop for this. And I think the real thing is that there's no perfect sell point at this point. You're just trying to make and capture a really decent gain versus what you risk. Can you speak to that?
Yeah, absolutely. I would just agree 100% to say almost all the real pros I respect, their focus and art is on the selling side, because in terms of profits, managing winners is the trickier part, because losers, they're just a cost of doing business. And every pro I know, that's has been in this game a while, the reason they're still in the game is because they've learned to manage those losses almost just like like a bodily function, like a cost of doing business, where those winners, you're trying to, squeeze the optimum amount of juice out of the lemon without, hanging on for the last drop, in the same way we want to be the last weak hand in the name. We don't really want to be the last weak holder. We want to sell it, before that and lock in a good, meaty part of the move. But your last point, I just want to emphasize, when you see like that gigantic volume, to the downside, that's the opposite of just exactly the opposite of what you want to see. That is a horrible sign, because just earlier, it's not, Aunt Betty or whatever analogy we use, buying a few hundred shares for her Roth account or whatever. That's not her selling a few hundred shares. That is massive profit taking. The pros are getting out, and they're telling you that they're getting out. They cannot hide their hand, guys. I can't emphasize this enough. So, any stock that has the largest decline on volume since the beginning of the move is probably off my radar for months at that point. Because it's just going to take a lot of time for that to potentially reset up, because it's telling you there's supply now sitting over that stock.
Yeah, the beautiful thing about charts and looking at price and volume is that the elephant can't get in the bathtub without the water rising. There's no way. You're going to detect it. You're going to detect the footprints of institutions. And in contrast, you're going to be able to detect the footprints of retail. And by being able to detect that, that's when when the strong hands are in control. And that skill is a very valuable skill to develop. It's going to take you a while, but believe me, it's well worth it. So now one of the reasons why selling is so difficult, especially using the type of techniques that I'm talking about and getting out when the getting's good. One of the reasons why you want to do it that way is because once the stock breaks, you're way better off selling into strength even at lower prices, because they'll break so fast that they'll give up a lot of your gain before you recognize that the stock is turned around, and you're using moving averages or whatever you may be using, what the common person uses. By the time they start showing all those signals, they've given back a huge percentage of their profits. And I'm sure you've been through that. You've experienced that yourself. So by selling into strength and starting to see when you get a bunch of up days versus down days, a bunch of good closes, and it looks just like what you're looking for with the confirmations, but now the stock price is accelerated and you're at a good size profit now, and you're seeing largest up day, widest spread, and you're really getting that jubilation, that exuberance in the stock. You, just like everybody else, you're elated. You're so happy, right? You're thinking this stock's going to the moon. You're looking at, Morgan Stanley just came out with a 2,000 price target. I remember, they did this with Qualcomm in the 90s. This price target was like $1,000 above where it was trading. That happened with, I'm sure that happened with Tesla and some of these other names at some point, where you start getting these price targets. That's where, you've got to really calm your emotions, look at the chart, and nail down a decent profit. Here you see where this stock, it's just meeting everything after it accelerates itself. And again, maybe you bought it right here. This is a perfect little VCP, little coupled handle. You could have been buying here, whether you bought earlier or you bought here. Now, after you make a nice move, it goes up from 12, 16, it goes up to $18. Now it accelerates. In just 4 days, it runs up 47%. You got the largest up there, the widest spread, multiple gaps. We're selling right into that. We don't care if it goes up tenfold from there, because we're getting out when the getting's good, and we're selling right into that strength. And that's the way you nail down these profits, and you keep your. Why don't you also speak, Mark, to the other benefit of this is your equity curve, right? What happens when you're selling to strength? What is that guarantee that you do with your equity curve?
You're smoothing it out, and this is an absolute pro tip, if you will, or advanced idea, that because the amateur just thinks, well, but the stock might go higher. So let's say you get that first largest update where it gaps. As far as your equity curve, though, let's say you sell the whole position there versus selling it 3 days later when it comes back down to the same price. Well, the amateur might think, well, hey, I achieved the same thing. But the reality is your equity curve just got much more volatile, where the individual